Let's break down today's market action with Bespoke Investment Group co-founder Paul Hickey and U.S. Bank Asset Management CIO Eric Friedman. Gentlemen, it's great to have you here as stocks settle. It does look like we had a mixed close with the Nasdaq down fractionally, the S&P up fractionally, and the Dow actually the best performer here of the major averages, finishing up about 0.5%. Paul, I want to go to you first because yields have really been the story that's been dictating what we see with stocks, but we also know we're coming off of two very strong years of gains for equities. So how to think about this and how much of this is profit taking and tax related selling as we do go into a new year and people are thinking about rebalancing their portfolios?
Yeah, so Morgan, I think you teed that up perfectly. So, there's a difference. The backdrop for the market and the economy looks very good right now. Problem is the starting point. We've had 2+ years of 20% gains. We had 50 record highs last year. We're entering the third year of a bull market, which historically has been weak. And in those prior two scenarios, when you have 50 record highs in a given year, you tend to see weakness in that following year. So we talked about this back last year, shortly after the election, is the market was rallying on positive news and positive backdrop, but it was seemingly rallying on the same news over and over. So you get to a point where, at some point you can't keep rallying on the same news and you need to pause. So we're in a new year. Investors are looking ahead to some uncertainty. They have every right and every excuse to take profits. So that's what we're seeing. The sectors did best last year, performed worst so far year to date, and the opposite sectors worst last year are doing the best year to date. So I think in that respect, it's just some consolidation here. And what we need is stabilization in interest rates. And this was shocking looking at it today. It's been 80 trading days since the Fed first cut rates in September. The 10-year yield has risen on 50 of those trading days. So that's unheard of. It's only happened 4 other times going back to the late 60s. So it's just this relentless, consistent rise in rates. But the plus side is that when you've seen these types of scenarios before where you had such a consistency of up days in the 10-year yield, it tended to occur near at least a short-term peak in rates. So we need stabilization in rates for the market to get back on its footing, and we could see that going forward here with treasuries way oversold. Yeah. And of course, per usual, Paul, some great historical context there in terms of the behavior we are seeing in this market. Eric, I want to get your thoughts on that, especially given the fact that we have seen yields move higher despite a Fed that started cutting in September, and I realize that there's the narrative of folks just sitting on their hands thinking the Fed's going to sit on its hands and hold now. But when I look at your price target for the S&P 500 for this year, it is 64.80, which is about 10% upside from here. So what gets us there? How do you position yourself for that?
Yeah, we're really excited about it finally being earnings season, Morgan. This is the sort of shoulder months where we've got a new calendar year. There's a ton of macro data. There's obviously a lot of speculation about the new administration. But we do think ultimately this will be about earnings. And so we're at a level where we think 24 times 270 is probably the most likely scenario. That's a little bit of a discount to market consensus right now. But we do think that probably the most important divergence to understand is what happens with consumers. We're past the holiday season. We have seen a lot of shifting, if you will, of tastes and preferences, a lot of divergences between higher income and lower income consumers. So this earnings season will be important, not just about what happened in Q4, but more importantly, outlooks. So I think that the stability that we've seen has been in tech and tech spending. It's kind of cliche to talk about tech. We still really like it. We think that, again, there's a reason for premium valuations. You're seeing IT budgets continue to expand, especially business to business. And so we still like tech here. We think that interest rates are certainly an important story. We think fair value for the 10-year is probably closer to about 425 or 430. So a little below where we are right here. And again, markets anticipating a little more clarity from the Trump administration about what's coming with tariffs. Right. So bottom line is this. We think that now that we're finally in earnings season, we're going to start hearing a little more clarity about spending and obviously how consumers are doing. We still think consumers are in good shape. That's why we're still bullish on equities here.